Good morning, students. Welcome you all on the second part of Ind AS 16, Property, Plant and Equipment. So student, let's quickly recap the last class in the next 2-3 minutes. We have discussed that in accounting standard AS 10 is there, which talks about property, plant and equipment. Earlier, the name was accounting for fixed assets. Earlier, there was a separate standard for depreciation, which was AS 6, but effective 1st April 2016, even in old Indian scenario, there is only a single standard, which is accounting standard 10, property, plant and equipment, right? And even that accounting standard was revised to make that standard align with Ind AS 16 PPE. In Ind AS, in financial reporting paper, it is Ind AS 16, property, plant and equipment. And I would say this standard is the king of the asset standard, right? In IFRS, I mean to say in global scenario, this is IAS 16, International Accounting Standard 16. There is no major difference, or I would say there is no difference between Ind AS 16 and IAS 16, right? So friends, as far as journey of the or life cycle of the asset is concerned, we'll talk about the birth of asset. I mean to say birth of property, plant and equipment. When I say birth of property, plant and equipment, I will talk about, or I have talked about, the recognition condition, right? And when a property, plant and equipment is required to be recognized as a PPE, when future economic benefit is probable and cost can be measured reliably, right? And of course, it should meet the definition of PPE as well, okay? So let's start this. And we have discussed the objective, we have discussed the scope also, that Ind AS 16 is applicable to all kind of property, plant and equipment except if a PPE is classified as held for sale. The intent for PPE is not to sell, right? But if the PPE is classified as held for sale, then it is out of the purview of Ind AS 16. Why? Because there is a separate standard Ind AS 105 which takes care of such kind of PPE. If there is a biological asset which is related to agricultural activity, right? Which is your animals, living animals, right? If there are animals which are used for agricultural activity, those animals are within the scope of Ind AS 41, not in the scope of Ind AS 16. Second, if the animal is used for commercial purposes or commercial activity, like event management company is using, is having these animals in their balance sheet. So these will be covered, these animals will be covered under Ind AS 16. Bearer plant means those trees, those plants which bear the agricultural produce for more than 1 year. So those bearer plant are also in the purview of Ind AS 16, not in the Ind AS 41. But if it is a non-bearer plant, then it will be covered under Ind AS 41. Recognition and measurement of exploration and evaluation assets, mineral rights, mineral reserves such as oil, natural gas and similar non-regenerative resources. So these are also covered under Ind AS 106 and hence outside the purview of Ind AS 16. And this standard is applicable to property, plant and equipment which are used to develop or maintain the above assets, right? So if a crane is used in the mining site, that crane is PPE. Definition of PPE we discussed. PPE are tangible item which is held for use in production or supply of goods and services, rental purposes, administrative purposes, and expected to be used during more than one period, which is technically more than 1 year. And in this rental part, there was one exception. And what was that exception? If a property which is land and building is used, exception. What is the exception? If land and building is used for rental purposes, held for rental purposes, land and building held for rental purposes, held for rental purpose, it is not PPE. It will be covered under Ind AS 40, which is investment property, right? Clear? Then friends, we discuss this case study to better understand the definition. Then we discuss the recognition criteria when an item has to be recognized as PPE, when two conditions will be satisfied, probable that future economic benefit will flow and cost can be measured reliably. Then only that item has to be recognized as PPE. As far as initial costs, for the subsequent cost, same criteria is there. If the company is incurring a subsequent cost, again, same criteria is there. Future economic benefit is probable and cost can be measured reliably. So you should always remember FC. Future economic benefit is probable and cost can be measured reliably. For spare parts, standby equipment and servicing equipment, if the spare parts, standby equipment and servicing equipment is meeting the definition of Ind AS 16, is meeting the definition of PPE and meeting the recognition criteria. What is the recognition criteria? Of course, it should be tangible. Of course, it should be tangible asset. It should be held for use in production or supply of goods and services, rental purposes, administrative purposes, and it should be used for more than one period. For example, in case of servicing of a car, air filter, diesel filter. So these are going to be replaced at regular intervals, right? So these are not PPE, these are inventory. Subsequent cost, the subsequent cost in the form of major expenditure, right? In the form of major inspection, major replacement, overhauls, etc. So these kind of subsequent cost is also required to be capitalized and recognized as PPE, right? If two conditions will be satisfied, future economic benefit is probable and cost can be measured reliably. But in that case, if you are recognizing such subsequent cost and capitalizing such subsequent cost, in that case, you have to decapitalize the old cost relating to that component. And please remember my example relating to truck and engine. This illustration number 8 relating to machine and turbine, right? So we have discussed these two examples in the Excel file. So you can refer that example and you will be able to understand that how the original cost will be calculated if the original cost is not given in the question, right? So friends, in that case, what we will do? So we will calculate the original cost by discounting the current cost, right? If today the money which we are spending to replace a component is, let's say, 10 lakh rupees. So what would have been the cost 6 years ago, 5 years ago? So how we can arrive at that cost? We will calculate the present value 6 years ago, right? By discounting it with a present value factor, by discounting it with a discount rate, right? This will give you the present value factor. Okay. So again, the same example we have discussed with the help of an aircraft and an inspection cost, the example of major inspection. Then we have discussed at what value PPE is going to be recognized. At what value? What is the value on which PPE is going to be recognized? And then we discussed, friends, PPE is going to be recognized at cost. But what is the definition of cost? Cost includes purchase price, of course, plus import duties, plus non-refundable taxes, minus discount and rebates, right? Plus directly attributable cost. What is meant by directly attributable cost? Directly attributable cost, simple meaning means if this asset would not have been acquired, this cost would not have been incurred, right? If this asset would not have been acquired, the freight cost, the transportation cost, the assembly cost, the installation cost, the training cost, these costs would not have been incurred. So all the directly attributable cost is required to be capitalized, right? And only those directly attributable costs which is necessary for bringing the asset to the location and condition, necessary for it to be capable of operating in the manner intended by the management. So Girish, please tell me, if I have to purchase a machinery from China and my factory is in India, so if that machinery would not reach to my India factory, can I be able to use that machinery? So that any cost directly related to bringing the asset to the location means bringing the asset to the India factory. So what could be the cost for bringing the asset to the India factory? Probably there is a cost for transportation, freight inward, carriage inward, right? There is a freight for clearing house agent, CHA charges. So there could be multiple costs which is necessary to bring the asset to the location, and condition necessary. And condition means if I would not do the installation, how can I use that machinery? If I'll not call the professionals, trainers Who will guide me that how to use that machinery? I cannot I cannot use that machinery, right? I will not be able to use that machinery. So directly attributable cost means cost directly related to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the manager, right? Then we discuss directly attributable cost needs to be capitalized plus initial estimate of the cost of dismantling and removing the item and restoring. If you are constructing an asset with a condition that after a certain period of time you have to remove that asset, you have to restore the site, you have to dismantle the asset, so it will carry some cost. So today when you are installing, constructing the asset, so in that case the estimate cost of dismantling and retirement, estimate cost of dismantling and site restoration and removing the asset needs to be added to the cost of the asset. But sir, you have taken an example of Reliance Industries, Krishna Godavari Basin. You have taken an example of a leasehold land on which factory is constructed. So if the cost is going to be incurred after 20 years, after 30 years, then what value should we capitalize today on account of this site restoration cost or asset dismantling cost? So it should be present value of the future estimated cost, right? And we have also covered an example for that where I have shown you the 20 years entire 20 years working, right? So friends, we have discussed some example what is not a directly attributable cost of conducting a business in a new location or with a new class of customer, cost incurred in introduction of a brand, right? Cost of opening a new facility, inauguration cost, administrative and other general overhead cost, decommissioning cost we discussed, and we have also done a case study 4 for this cost of the asset, right? And we have discussed the example of deferred payment credit or concept of deferred payment credit. And what was the concept? So deferred payment credit, if an entity is acquiring a fixed asset on the deferred payment terms, in that case the PPE has to be recognized, PPE has to be measured and recognized in the books of accounts at cash price equivalent. If I would buy the PPE today at the normal credit terms or at the cash price, then what would be the cost which is going to be incurred by me, right? So on that value PPE is going to be capitalized. But sir, if it is a deferred credit terms and the supplier is asking for some extra money in comparison to cash price equivalent, then what will be the treatment of that extra? That extra will be treated as a interest or finance cost, right? And if the underlying asset is a qualifying asset, then that interest or finance cost is going to be capitalized as per Ind AS 23. But if the underlying asset is not a qualifying asset, then that interest or finance cost will be charged to P&L. Then we have discussed the concept of exchange of asset. If you are exchanging an asset and in return you are acquiring an asset, then standard says that yes, of course this could happen. Probably you will buy an asset and you will pay some cash and some asset. So this will be considered as a combination of monetary and non-monetary asset. But at times you will be exchanging one asset with the another asset. DLF is selling flat in return of buying a Mercedes car. Now the question arises, at what value the acquired asset needs to be recorded in the books of accounts? We understood about the surrendered asset. The surrendered asset has to be derecognized at the book value. Of course, whatever is the book value, you have to derecognize that book value. But what about acquired asset? Standard says that the acquired asset has to be recognized at WDV of the asset given up if the exchange transaction does not have any commercial substance. I am exchanging flat number 802 with the flat number 801 in the same society, same identical flat I'm exchanging, right? So the transaction is not having any commercial substance. In that case, the acquired asset has to be recorded at the WDV of the asset given up, or I cannot determine the fair value of either the asset received or the asset given up. In that case, again, the acquired asset has to be recognized as the WDV of the asset given up. Sir, but in all other cases, what you are required to do? In all other cases, you are required to recognize or measure the acquired asset at fair value. Your cost is equal to fair value. Sir, fair value of what? Fair, if the fair value of asset acquired and asset given up, both is given, both is identifiable. In that case, whatever is more evident, more clearly identifiable, you have to apply that, right? Sir, but if both are clearly identifiable, then you need to take what? You need to take what? You need to take fair value of the asset, fair value of the asset given up, because it is the consideration which you are paying for acquiring the asset. It is the consideration which you are paying for acquiring the asset. So fair value of the asset given up has to be given the first priority. And you know, I have also mentioned these things in my Excel file, which I'm going to share with you today. So the entire hierarchy I have also jotted down in the Excel file. Friends, in the last 15 minutes, I have summarized the last class of 3 hours, right? Before starting the today's agenda, before starting the today's agenda, let me know if there is any query, any question. And I hope you had a good revision of the last class. So I can see the response on the query link by Manini, by Aisha, Soham, Girish, Rashmi, Rohan, Radhika, Rahul. Yeah, so good guys, let's start the session today. Let's start the agenda for today. Friends, so far we have discussed about measurement, about recognition, about subsequent cost, about measurement at initial recognition. Now let's discuss measurement subsequent to initial recognition. And what does it mean? What does it mean? Measurement subsequent to initial recognition means, for example, if I purchase a car today, which is let's say 5th November 2022, and I purchased a car at 10 lakh rupees, right? So what is the initial recognition? Initial recognition means recognition at transaction date, right? So at the transaction date, what accounting entry I need to pass? At the transaction date, I will pass an accounting entry, car account debit to bank account. If I have purchased the car on credit basis, for example, normal credit terms, not a deferred credit terms, normal credit terms, then what accounting entry I need to pass? Car account debit to creditor account, to sundry creditor, to trade payable account, 10 lakh rupees, right? So this is initial recognition. Okay. What is meant by subsequent to initial recognition? Subsequent to initial recognition means at reporting date. So when 31st March came, when 31st March will come, what accounting entry I need to pass? I need to depreciate. I need to depreciate this car, right? Over the useful life of the car. So yes, of course, I need to pass an accounting entry, which is depreciation, depreciation account debit to accumulated depreciation account. Second, I need to pass an accounting entry for, I need to check impairment losses also, right? So at the reporting date, you have to ensure that the carrying value in the books, carrying value in the balance sheet should not be more than the recoverable amount, right? If the recoverable amount of asset is, let's say, 10,000 rupees, and the carrying amount in the balance sheet is coming out at 15,000 rupees, then according to the accounting principle, according to Ind AS 36 impairment standard, according to Ind AS 16 standard, the recoverable amount, if it is less than the carrying value has to be impaired to the recoverable value, and you have to book an impairment loss, right? So this we will do. And of course, friends, the standard talks about the two models in case of a subsequent recognition. And let me share the Excel file, and then I'll discuss these two models with you guys. I hope my Excel file is visible to all of you. Yeah. So measurement subsequent to initial recognition. Standard says that subsequent to initial recognition, first of all, initial recognition means recognition at transaction date. Subsequent to initial recognition means recognition after transaction date. That is, for example, let's say that is reporting date. That is at reporting date, right? So standard says that after initial recognition, subsequently the property, plant and equipment has to be recognized either at cost model or revaluation model. And I know that these models are not new to you. You guys have already heard about these models in AS 10 as well. Revaluation model, right? Cost model and revaluation model. So when I talk about measurement after initial recognition, it mean to say that at what value the carrying value has to be carried in the balance sheet. At what value the carrying value has to be carried in the balance sheet. So first of all, cost model means the PPE, property, plant and equipment, is carried at original cost. Original, right? So friends, measurement after initial recognition means at the reporting date, at what value you will carry the PP in your balance sheet. It means what will be the carrying amount. What will be the carrying amount? So the carrying amount in cost model, what is meant by cost model? Cost model means you have to carry the PP always at cost. You have to carry the PP at cost. Cost means original cost, right? Sir, are we not required to depreciate that PP? Yes, you are required to depreciate. And that is why the definition of carrying amount is, what is the definition of carrying amount? Carrying amount is equal to original cost minus accumulated depreciation minus accumulated impairment losses, right? Minus accumulated impairment losses. Clear, friend? So this is the definition of carrying amount. For example, the original cost is rupees 1 lakh, right? The useful life is equal to 10 years. The original cost is 10 lakh, the useful life is, let's say, 10 years. Impairment loss at the end of second year is rupees 5k, is rupees 5,000. Okay, let me write, I'll write down it as a 5,000. Compute carrying value at the end of first and second year if the company has opted for cost model, right? Friends, in this case, what is the definition of carrying amount? The definition of carrying amount is equal to original cost minus accumulated depreciation minus accumulated impairment losses. So your original cost is 1 lakh rupees. Cost is 1 lakh rupees. 1, 2, 3, 4, 5. Okay. Cost is 1 lakh rupees. Depreciation less. Depreciation for first year. Less depreciation for first year. So if the life is 10 years, what will be your depreciation? This divided by 10. 10,000 is your depreciation less. Impairment loss. There is no information of impairment loss is given for the first year. Nothing is given, right? 0. Okay. Now what is your carrying value at the end of the first year? At the end of the first year, carrying value is 90,000. So carrying value at the end of first year. right? And now this carrying value at the end of first year will become the opening value and at the beginning of second year, right? So again, depreciation for second year. What will be the depreciation for second year? Of course, going by the useful life, the remaining life is 9 years. So 90,000 divided by 9. 90,000 divided by 9. 10,000 less impairment loss is given in the question as 5,000. 5,000, right? Impairment loss is given in the question as 5,000. So what is my carrying value at the end of the second year? What is my carrying value at the end of second year? Carrying value at the end of second year. At the end of second year. 90 minus 10 minus 5. Friends, 75,000 will be my carrying value at the end of second year. 90,000 will be my carrying value at the end of the first year. Friend, this is meant by the cost model. In the cost model, you have to carry the PPE at original cost. I mean to say gross block. Your gross block will always be the original cost, right? And you need to depreciate your PPE over the useful life. And if there is a impairment losses, you have to book the impairment losses. Sir, what about the third year? What about the depreciation for third year, assuming there is no impairment loss? What about the depreciation for third year? Hence, in this case, the depreciation of the third year will be calculated on the opening value, which is the closing value of the second year will become the opening value of the third year. So the remaining life will be 8 years. The remaining life will be the 8 years, right? In this case, so depreciation has to be charged 75,000 divided by 8. So depreciation has to be charged prospectively on the remaining value of the fixed asset, on the WDV of the PPE, right? This will be your 9375. And for example, no impairment loss is given in the question. The impairment loss will be 0, right? And what will be your closing WDV? What will be your closing value, carrying value at the end of the third year? The carrying value at the end of third year is 75,000 minus 9375 minus impairment losses. It is coming out as 65625, right? So understood. In the first case, we have divided 90 by 9. In the second case, we have divided 75 by 8 years. Okay, this will be the carrying value at the end of the third year. I hope it is clear to all of you, friends. I hope it is clear to all of you. Yeah, good. So cost model is pretty simple. Now, what is meant by revaluation model? Can anyone tell me what is meant by revaluation model? And I know all of you are aware about these models. These models you have heard in your accounting standard 10 as well, right? So friends, let's talk about the revaluation model. What is meant by revaluation model? Revaluation model means fair value. Okay. Means subsequently recognizing, subsequently measuring, not recognizing, subsequently measuring this PPE at fair value. Okay. Subsequently measuring this PPE at fair value. Okay. So when you are measuring the PPE at fair value, in that case, what will happen? In that case, what will be your carrying amount in the balance sheet? If you are fair valuing your PPE, if you are revaluing your PPE, what is the definition of carrying amount? What is the formula for calculating the carrying amount in your balance sheet? Formula is this original cost will be replaced by the revalued cost. Will be replaced by the revalued cost. Will be replaced by the revaluation amount. Revaluation amount, right? So revalued cost, revalued amount minus not accumulated depreciation minus subsequent debt minus subsequent debt minus subsequent impairment losses minus subsequent accumulated impairment losses. Have you understood this? For example, the original cost was 10 lakh rupees, right? The original cost was, sorry, 1 lakh rupees. The useful life is, let's say, 10 years. Okay. Useful life is 10 years. Impairment loss at the end of third year, is rupees 5,000. And the revalued amount, or let's say the company has revalued this PPE at the end of second year at, let's say, at 1.20 lakhs, right? At 1.20 lakhs. Compute the carrying value. Compute the carrying value at the end of the first, second, and third year. At the end of first, second, and third year, if the company has opted for revaluation model. Okay. So in this case, what was my original cost? What was my original cost, friends? Original cost at the time of initial recognition, at the inception. Original cost at the inception is 1 lakh rupees, right? It is at 1 lakh rupees. Clear? Depreciation at the end of first year, because there is no revaluation, depreciation will be charged on this original cost of 10 lakh. So this divided by 10. There is no impairment loss. There is no impairment loss, right? Nothing is given in the question. There is no impairment loss which is given in the question. Less impairment loss. This is 0. What is your carrying value at the end of the first year? So your carrying value at the end of first year will be is 90,000. Carrying value at the end of the first year is 90,000. Again, you need to depreciate this PP. Depreciation at the end of the second year. First you need to depreciate. So this will be again 90 divided by 9. 10,000 is your PP. Is your depreciation on PP, and there was no impairment loss. Less impairment loss. There was no impairment loss. So friends, it is coming out at 80,000 at the end of the second year, right? But so this is your 80,000 at the end of the second year. But the revalued amount at the end of second year is not 80 is not 80,000. It is 1,20,000. 1,20,000 is the revalued amount at the end of the second year. What does it mean? It means if the company has opted for revaluation model, then for the third year, or I would say at the end of second year, this PPE has to be stated, or PPE has to be measured at revalued cost as the revalued amount. So what will be the carrying value at the end of the second year? The carrying value of the PPE is 1,20,000, right? So what is the definition of carrying amount? Carrying amount definition is revalued cost. What is your revalued cost? Your revalued cost is 1,20,000 minus subsequent accumulated depreciation. Subsequent means after revaluation. So friends, after revaluation, is there any depreciation? After revaluation, is there any depreciation? After revaluation, is there any depreciation? Answer is no. At the end of second year, answer is no. So friends, in this case, carrying value at the end of second year is 1,20,000, is 1,20,000. Okay. At the end of second year is 1,20,000 by using revaluation model, by opting revaluation model. Clear? So this revalued cost minus subsequent accumulated depreciation minus subsequent accumulated impairment loss. Now less depreciation at the end of the third year. Depreciation at the end of the third year. Now friends, remaining life is 8 years and subsequent depreciation will be charged on the WDV. And what is the WDV now? Now the WDV become 1,20,000. So 1,20,000 divided by remaining life, it is 8 years. 15,000 is the depreciation. Less impairment loss also. You need to check impairment loss also. And in the question, impairment loss at the end of the third year is given at 5,000. 5,000. Friends, in this case, now I have to compute the carrying value. I have to compute the carrying value at the end of the third year. And the company has also done the revaluation last year, right? Carrying value at the end of the third year is equal to revalued amount. What was my revalued amount? It was 1,20,000, which happened in the last year. And after that, what is my subsequent depreciation? It is 15,000. What is my subsequent impairment loss? It is 5,000. So 120 plus 15 plus 5. 1 lakh will be the carrying value at the end of the third year. I hope the formula for calculation of carrying amount, the concept of cost model and the concept of revaluation model is clear to everyone with the help of this example, right? Is it clear, friends? I hope it is clear to everyone. Good. Thank you, Radhika. Great, guys. Okay. Let's move on. So we have understood that if a company is opting for revaluation model, in that case, your original cost will be replaced by the revalued amount, right? And once you have done the revalued amount, of course, you have to reduce the depreciation and impairment losses after that revaluation. Okay, after that revaluation. For example, we have seen that at the end of the second year, by opting the cost model, it was 80,000. But since you have revalued asset, so friends, when you have revalued that asset, the value will not be 80,000. The value will be 1,20,000. The value will be 1,20,000. Why? Because 1,20,000 is at that point of time value, right? So when you are arriving at a fair value, the fair value is for a specific point of time. And at the end of the second year, the fair value is 1,20,000. What does it mean? It means after considering everything, after considering depreciation, impairment losses, everything, the current price is 1,20,000, right? And that is why revalued, that is why when the company is opting for revaluation model, the subsequent depreciation and subsequent impairment loss has to be considered, okay, for calculation of carrying amount in the balance sheet. Sir, what happens if the company has again revalued at the end of the third year, and at that point of time the value is, let's say, 1.5 lakh, friends? In that case, the revalued amount will be 1.5 lakh. The subsequent depreciation will be charged on 1.5 lakh, right? But whenever you will do the revaluation, that will become your cost, right? And of course, you have to reduce the subsequent depreciation and subsequent impairment loss after the latest revaluation. Okay. So every time when you will do the revaluation, it will replace your earlier carrying value. As simple as that. So whenever you will do the revaluation, at that point of time, it will become your opening carrying value, right? I hope it is clear to all of you. Grish is asking, sir, difference between 80,120 will be transferred to revaluation surplus. Yes, Grish, it will be transferred to revaluation surplus. Although I will discuss on this also, right? Yes. Now the question arises, sir, why revaluation model should be adopted? Right. So friends, revaluation shows the actual picture, or I would say actual picture or fair value of the assets at a particular point in time, right? Now, the question would be at what frequency? At what frequency the revaluation has to be done? At what frequency the revaluation has to be done? At what frequency, sir? Frequency revaluation is required to be done. At what frequency revaluation is required to be done? Friends, let me tell you, normally the companies do the revaluation for its properties, right? Land and building, factory. So revaluation is not a desktop exercise. It's not like that you will just sitting on the desktop or laptop and you are just performing this revaluation exercise. Revaluation exercise needs some cost as well. It will incur some cost as well. You have to engage some valuers, right? And of course, for revaluation, valuer will charge some fees, right? So revaluation is not a simple, it's not a free of cost exercise, it's a cost compulsive exercise. Now the point is, at what frequency revaluation is required to be done? Should it be done at every reporting date, or it is okay if we'll do the revaluation after every 3 years, 5 years? Then what is the criteria? Friends, standard says that if there is a major volatility, in the prices, then do the revaluation at every reporting date, right? For example, 31st March. If there is no major volatility in the prices, then do the revaluation at the interval of 3 to 5 years. It is more than sufficient at the interval of 3 to 5 years. So friends, I still remember in 2011 or 12, I was looking at the property to buy a property or to buy a flat near Anand Vihar. So it is in UP, Uttar Pradesh. So I was looking in Vaishali. And I still remember that every week the price was changing, every week. For example, because I'm working in a company, so I got the time on weekends only. So for example, on one weekend, I went to visit some property dealers or builders. So the price of 3-bedroom flat was 50 lakh rupees. When next week I went with my family, the price become 52 lakh or 55 lakh rupees, right? Next to next week, when I visited for the same identical flat of another builder, the price is 57 lakh rupees, right? So every week the price was changing. The market was very volatile. Right? And I can tell you, the flat which I have seen and the same flat which I have bought after 1 month, the price which was initially quoted at the first visit was close to 40 lakh rupees. And the price at which I have bought the same flat after 1.5 months, it was around 48 lakh rupees. Right? So you can understand that price was changing extremely. The price was changing rapidly. Standard says that if the company is opting for revaluation, it has to be at sufficient interval. It has to be done consistently, okay, from one period to another. But the point is, whether at every reporting date, engaging the valuer and paying him a fees and getting the report is mandatory. Answer is no. Standard says that if there is a major volatility, then you have to do the revaluation at every reporting date. If there is no major volatility, then you have to do the revaluation at the interval of 3 to 5 years. Sir, what is meant by major volatility? Friends, major volatility means you can fix you can set it as an accounting policy, right? You can say that if there seems to be a more than 10% change in the price of the property, more than 10% change in the price of the property, then we will consider it as a major volatility. Otherwise, up to the 10% change in the price of the property, we will not consider as a change in as a major volatility. And in that case, we will do the revaluation at a frequency of 3 to 5 years, right? Sir, but for knowing whether the 10% change, for knowing the 10% change, again, we have to engage a valuer. Answer is no, my dear friends. You can determine or you can fix your policy in a manner like circle rates. Do you understand the circle rate of the property? Like in every area there is a circle rate, means government rate of the property, right? For example, you are having a property of 500 square yards, and the circle rate of 1 square yard is, let's say, the government rate is 10,000 rupees. Okay, and in the next year it become 10,500 rupees. So the change is only 5%. In this case, I will not go to enter into a revaluation exercise, or I will not go to measure the fair value of that property, right? And friends, let me tell you, the circle rates and the market value of the property are the quite two different concepts. Okay, probably you will ask that, sir, if you are aware about the government rate, then why you are not multiplying with the government rate and taking it as a fair value? So that will not be considered as a fair value in case of property, right? Why? Because you must be aware about that the circle rate are not the true reflector of the fair value of the property. If you will look at the circle rate in Delhi, for example, the circle rate, according to the circle rate, the value of the property is 50 lakhs, but probably the market value of the property is 1.5 crores, right? I hope it is clear to all of you. Yeah, sir, if we want to revalue 2 times during the year, can we do that? Answer is yes. You can do that if the major volatility is there. You can do that. Okay, there is no restriction or no prohibition for revaluing this property. Okay, we understood this carrying amount calculation. We understood that revaluation model means keeping the asset at fair value. We understood that why revaluation model should be adopted. We understood at what frequency revaluation is required to be done. Okay, and the question arises, whatever model the company is applying, entity needs to apply cost or revaluation model consistently to the class of asset. What does it mean, sir? What does it mean? First of all, let's understand the meaning of class of assets. Student, can you tell me what is the meaning of the class of asset? Can you please help me in understanding the meaning of the class of asset? Yeah. So accounting policy, cost model or revaluation model should be applied to the whole of the class of property, plant and equipment, and not merely to the individual asset within the class. Now, what is meant by a class of asset? A class of asset means a grouping of asset of a similar nature and use in an entity's operation. Class of asset means a grouping of asset of a similar nature and use in an entity's operations. Sir, what could be the example of the class of assets? Okay. Example of the class of asset is office building, factory building. A company has 5 office buildings located at a different places in India. So all these office buildings, what is the use? The nature is similar. These are the office buildings, and the use is to maintain. The use is not to manufacture, not to trade. The use is to use these offices for the administrative purposes, right? Factory building. The company has 2 factory buildings. One is at Bhilwara and one is in Jalandhar, right? So the use in the entity's operation for these buildings, these factory building is to manufacture the goods, right? So factory building is used for manufacturing, office building is used for administrative purposes, right? So grouping of asset of a similar nature and use in an entity's operation, vehicles, another class of asset, machinery, aircraft. Have you seen the class of asset in the last example of Reliance Industries Limited in the last class when I show you the annual report of Reliance Industries Limited? Furniture and fixture, office equipment, computer and laptops, yeah, land, ships. These are the example of class of asset, right? These are the example of class of asset. Whatever accounting policy you will apply, cost model, revaluation model, it should be consistent. It should be consistent for a class of asset. Okay. Sir, what does it mean? Let's take an example. Example number one. Example. An entity has 5 office buildings, right? So an entity has 5 office building, Delhi, Mumbai, Jammu, Kanpur, Ludhiana. Jammu, Kanpur, Ludhiana. Right? For Delhi building, the value is increased. For Mumbai building, the value is increased, right? But for Jammu, the value is decreased. For example, some terrorist encroachment is there, so value is decreased. For Kanpur, value is decreased. For Ludhiana, value is decreased, right? Now, the company has these 5 office building, and now the company wants to, wants to make the balance sheet more bulky, more stronger, right? So the company is saying that let me use the revaluation model for Delhi building, again revaluation model for Mumbai building, but I will go for the cost model in case of Jammu building and Kanpur and Ludhiana cost model. So the company is saying, since the value of the Delhi and Mumbai office has been increased, building has been increased. So when I used revaluation model, of course, I will have one way on the asset side, I will have a asset worth more of the value, and I have the revaluation surplus in my reserves and surplus, right? And since the Jammu, Kanpur and Ludhiana value is decreased from the cost, so I will carry it the cost model and I will keep it at original cost. Okay. Now the question arises. This is 5 office building. These are the 5 office building. And what is the class of asset? These 5 building consist of one class of asset, which is office building, right? Now the question arises, can the entity choose such policy where the 2 asset within the same class has to be taken at revaluation model and 3 asset within the same class has to be taken at cost model? Answer is no. This is a wrong treatment. Answer is no. This is a wrong treatment. The company cannot apply such policy on the individual asset within the class. The company cannot apply such policy on the individual asset within the class. Okay. So it has to be consistent. Either it could be revaluation, either it could be cost model. The company has to apply a consistent model, either revaluation or cost model, to the entire 5 office building, right? So the company needs to apply a single model, doesn't matter revaluation or cost, to the entire 5 office building, as all the assets within same class has to be carried using the same model. Clear? Is it clear, friends? Another example. Same example I'm carrying. Same example I'm carrying here. This is the scenario. Delhi building is office building. Again, Mumbai building is office building. Jammu is factory. Kanpur and Ludhiana is also factory building. The company has decided to use revaluation model to this building. Again, for Mumbai, revaluation model. But for Jammu, Kanpur, and Ludhiana, the company wants to apply the cost model. Tell me, is it okay? Tell me whether the above is justified in accordance with Ind AS 16. Tell me, friends, is it okay to apply revaluation model to the office building and the cost model to the factory building? Is it okay to apply? Tell me, friends. Tell me. Yes, it is okay. The office building and factory building is two different class of asset. It's two different class of assets. Hence, the above is in accordance with Ind AS 16. Okay, with Ind AS 16. Why it is two different class of asset? Definition of the class of asset is similar nature and use in an entity's operation. The office building and factory building is not of the similar nature. They are not having a similar use, right? Office building is used for the administrative purposes, office purposes, and factory building is used for the production purposes, right? Is it clear? I hope it is clear to all of you, friends. I hope it is clear to all of you. Yeah. Okay. So let me open my PowerPoint presentation and then I move to the next concept. Measurement subsequent to initial recognition, the company can choose either cost model or revaluation model as its accounting policy, right? Accounting policy should be applied to the whole of a class of PPE and not merely to the individual asset within the class. If the class of asset is having 5 items, 10 items, so to entire 5 or entire 10 items, a same class is required to be applied. A same model is required to be applied, right? Like in my first example where I was talking about applying revaluation for 2 assets and applying cost to 3 assets, that is not acceptable, right? But in the second example, that is acceptable. Why? Because there are 2 different class of assets, right? And within and the assets within the class asset within the class of asset, we are applying the same model. So there is no any problem. If we have to apply the cost model, the definition of carrying value is cost minus ECDEP minus accumulated impairment losses, right? If we are applying a revaluation model, after initial recognition, PP to be carried at revalued amount, being its fair value at the revaluation date. What is the formula? Revalued amount minus subsequent accumulated depreciation minus subsequent accumulated impairment losses. If a single item of a PP is revalued, then the entire class of PP to which that item belongs should be revalued. There is no cherry pick choice. If you are revaluing one building within the class, you have to revalue the entire 6 building within the class, entire 5 building within that class. Class of assets means a grouping of assets of a similar nature and use in an entity's operations, right? So revaluation model, I have told you the valuation need not to be performed at every year or every reporting period. It has to be at sufficient regularity such that the carrying amount does not differ materially from the fair value. It has to be at sufficient regularity. But where the movement in fair values are volatile, that are major and significant, right? Then you have to do the frequent revaluation at every reporting date, or even it is okay if you will do the revaluation twice in a year or thrice in a year if there are major volatility. If there is no major volatility, then 3 to 5 years is more than sufficient. Okay. Is it clear? Clear, friends? Okay. Now let's discuss the treatment of revaluation gains and losses. The treatment of revaluation gains and losses. Let me know if there is any doubt, any problem so far. Let me know if there is any problem so far. Soham is asking, sir, do we have to disclose in accounts which method is used for which class of assets? Yes, Soham, you have to disclose in notes to accounts. Manini is asking, sir, in deciding class of assets, Ind AS 16 provide the criteria or the company will decide. So Manini, Ind AS 16 has provided only the guidance, right? And what is the guidance? The class of assets means grouping of assets having a similar nature and use in an entity's operations. So Manini, it will depend that what is the use in an entity's operations. So of course the intent, the business model or the operation of the company will decide the class of assets, right? There is no criteria given in Ind AS 16. Ind AS 16 has only given a guidance. And what is the guidance? It is of a similar nature and use in an entity's operations. So there could be an item which could be different to one company and which could be different to other company according to the use in it, their operations, right? According to the use in their operations. Clear? Good. Yes, Radhika, you can apply revaluation model. For example, there are 5 class of assets. You can apply revaluation model to 3 class of assets, and you can apply cost model to 2 class of assets, right? It is allowed. But yes, very well articulated, Rohan. Yes, within that class, all the assets, all the items within a same class, all the item has to be treated in a same manner, right? Either cost or revaluation. Good. So friends, now if there is a revaluation, in case of revaluation, if there is a gain or loss, what will be the treatment of revaluation gain and losses? Revaluation gain and losses. What is the treatment of revaluation gains and losses? If you will opt for revaluation model, of course there will be a gain or loss. Then what will be the treatment? So let me explain the treatment with the help of an example. A building was purchased. A building was purchased as per the following dates. Case 1. First April 19. A building was purchased on 1st April 19 for rupees 10 lakhs. For rupees 10 lakhs. Right? At the end of the first year, on 31st March 20, the price of the building was increased to 12 lakhs. And at the end of the second year, 2021, the price of the building was decreased to 9 lakhs. Right? This is the information given in the example. And there is a case 2 as well. There is a case 2. Right? And case 2 says that on 1st April 19, the building was purchased at 10 lakh rupees. Right? On 31st March 20, that is after 1 year, the value of the building was reduced to 7 lakhs. And at the end of the second year, it was increased to 11 lakhs. Right. Now we need to discuss the treatment of revaluation gains and losses. The company has opted revaluation, right? Let's understand what is the treatment of revaluation gains and losses. So we will discuss the case 1 first, then we will move to the case 2. In the case 1, first of all, when we are ignoring depreciation, right? Just I want to make you guys understand that what is a concept, right? Friends, in the when we have purchased this asset, it was worth 10 lakh rupees, right? After 1 year, the value of the asset was increased to 12 lakh rupees. And in the second year, the value of the asset was decreased to 9 lakh rupees, right? So the first case, in the first case, which is 31st March 2020, what is the accounting entry? What is the accounting entry? The accounting entry would be building PPE account debit. We will debit this. Why? Because the value of the building has been increased. So building PPE account debit 12 lakh minus 10 lakh. It has been increased by 2 lakh. Building PPE account debit to revaluation surplus. To revaluation surplus. Okay. Building PPE account debit to revaluation surplus. Okay. And this revaluation surplus will be in the OCI. Revaluation surplus. Okay. Building PP account debit to revaluation surplus. OCI. Credit. Clear? This will be credited. Debit, credit. So friends, if there is a revaluation surplus, it will go to other comprehensive income. It will go to other comprehensive income. You know why? You remember we have discussed this while discussing Ind AS 1? Because this is an income, but income not in the nature of normal income. It is an income in the nature of reserve, and that is why it should go to OCI. By revaluation surplus, your net worth, your net assets will increase, and this is not a transaction with the shareholder. So this will go to OCI. This will go to OCI. Okay. Yeah. So building account debit to revaluation surplus 2 lakh rupees on 31st March 2020. What about the next year on 31st March 2021? What will the next year on 31st March 2021? In the next year, the value of the building has gone down to 9 lakhs rupees. So it has been reduced by 3 lakhs rupees. So in the next year, standard says that when there is an increase, you have credited the revaluation surplus. But whenever there is a subsequent decrease, so whatever reserve you have created in OCI, first of all, you have to reverse that OCI, right? So first of all, we will hit the revaluation surplus OCI, whatever we are having as of now. Yeah, and logical also. So we will credit this. We will debit this OCI reserve first, and we will credit building PP. We will credit to building PP account, and we have to credit this PPE. We have to credit this PPE by 3 lakh rupees. By 3 lakh rupees, 12 minus 9. 12 minus 9. 3 lakh rupees, right? Because the value of the PP has been decreased, so you have to credit this. Where the difference of 1 lakh will go? The difference of 1 lakh will go to the impairment loss in the P&L. It will go to the impairment loss in the P&L. Impairment loss debit in the P&L by 1 lakh rupees. I hope this accounting entry is clear to all of you. Friends, what we have done, when there was initially an increase, we have credited our other comprehensive income reserve with that increase. Subsequently, whenever there is a decrease, to the extent of increase, we have adjusted to the extent of increase, we have adjusted the decrease from the reserve which we are already having. And beyond that, we have debited our P&L. Right? I hope it is clear to all of you. Yeah. Now let's move to the case 2. What will be the accounting entry in case of case 2? In case of case 2, on 31st March 2020, what is the accounting entry? Friends, on 31st March 2020, first, what you are required to do first, on 31st March 2020, the value has been decreased. The value has been decreased. It has gone down. It has gone down, right? So the value has decreased. So when this value has decreased, just a minute. When this value has decreased, what you are required to do? You have to credit your PPE. You have to credit your PPE, of course. Yes, to building PPE, to building PPE account. And you have to credit by how much amount? You have to credit by 10 minus 7. 3 lakhs. So what you will debit, friends? You will debit impairment loss. It is decreased. It is not a reserve. It is decreased. So impairment loss, this has to be taken to the P&L. Conservatively, this has to be taken to the P&L. Impairment loss account debit. Impairment loss account debit. And this building PP needs to be credited, right? So impairment loss is required to be booked in the P&L, right? 31st March 2021, what accounting entry you will pass on 31st March 2021? Friends, on 31st March 2021, this has increased. This has increased by 4 lakh rupees. This has increased by 4 lakh rupees. So what you are required to do? What you are required to do? This has increased by 4 lakh rupees. So what you will do? In this case, since there is an increase, so first of all, you will debit the PP, building PP account debit. By how much amount? Building PP requires to be debited by 4 lakh rupees. Right? Now tell me, what will be the credit? What will be the credit, friends? What will be the credit? 2. First of all, to the extent you have debited your P&L, you have to reverse that to impairment loss P&L. To impairment loss P&L. You have to reverse that to that extent. To impairment loss P&L. By how much amount? Whatever you have debited, you will credit that by 3 lakh rupees. Still, you have a buffer of 1 lakh rupees. Where that buffer will go, where that extra will go, that extra will go to the revaluation surplus OCI. To revaluation surplus OCI. 4 minus 3, which is 1. Is it clear to all of you? Is it clear to all of you? Or let me know if you have any doubt here. Is it clear to all of you? Or let me know if you have any doubt here. Yeah? Clear? I hope it is clear to all of you, friends. I hope it is clear to all of you. Okay. Yeah. So friends, let's discuss one of the example from Institute study material. Then we will move on. Okay. Let's go to the presentation first. Yeah, revaluation gains and losses. First time if there is an increase, you have to credit it to revaluation reserve OCI, right? Subsequently, it is again increase. Again, it will go to revaluation surplus. But first time if it is increase, then decrease, then of course you have to first adjust from revaluation reserve, revaluation surplus, then excess will go to the P&L. Excess decrease will go to the P&L. First time there is a decrease, so there will be impairment loss will go to the P&L. Again there will be a decrease, again it will go to the P&L. But first time decrease, then increase, then you have to reverse your P&L, right? First. So first charge to P&L to the extent of earlier debit, then whatever is remaining, you have to take it to the revaluation surplus OCI. I hope it is clear to all of you. Yeah. So friends, let's discuss this case study. Then we will go to the next concept of revaluation surplus. ABC Dynamic Limited has purchased 2 buildings, A and B, for rupees 10 lakhs and 15 lakh respectively on 1st April 2013, right? The company is using these buildings to running its office and maintaining its godown. Running its office and maintaining its godown, right? So one is office, the second one is go down. The nature, it could be a similar nature. Building is there, but the use is different. The office has been used for the administrative purposes, right? But the go down is used for keeping the goods, right? The company is using revaluation model for subsequent recognition of its all class of buildings. The fair value of building is as follows, and the company is using the revaluation model for all class of buildings, right? The company has purchased building A for 10 lakh. The value was 10 lakh when it was purchased, and building B was purchased for 15 lakh on 1st April 2013. These were the value of the building when it was purchased. Okay. On 31st March 14, it becomes 14, then 9, then 11. Again for B, it becomes 14, then 16, then 13. Calculate carrying amount of building A and B and treatment of revaluation gains and losses along with balances, if any, in revaluation surplus account on 31st March 14, 15, and 16. Friends, first of all, let's talk about building number A. The cost of the building A was 10 lakh. And the revalued amount on 31st March 14 is 14 lakh. So first time there is an increase. What is the accounting entry? Building account debit, building number A account debit to revaluation surplus by 4 lakh rupees, right? And this revaluation surplus will go to the OCI reserve, OCI. Again, subsequently, in the next year, this 14 become 9 lakh. This 14 become 9 lakh. So subsequently, there is a decrease of 5 lakh. Earlier, there was an increase of 4 lakh and there was a decrease of 5 lakh. So if there is a decrease, building A will be credited. So to building A, 5 lakh. And to the extent of revaluation surplus, we have to reverse that. So revaluation surplus account debit 4 lakh, to building 5 lakh, and the differential debit will go to impairment loss P&L 1 lakh rupees, right? So till 31st March 15, there is no revaluation surplus, right? The value of the building comes out at 9 lakh rupees, and there is 1 lakh rupees of hit in the P&L in terms of impairment loss. Subsequently, this 9 become 11. So again, building A will be debited by 2 lakh rupees. But what will be the credited? The entire revaluation surplus OCI will be credited. Answer is no. To the extent of earlier debit, and now we have a debit of 1 lakh which have been put in the last year. So building account debit 2 lakh, to impairment loss P&L reversal 1 lakh, to revaluation surplus OCI 1 lakh, right? This will be the accounting entry. In building number B, what will happen? In building number B, it was purchased for 15 lakh rupees. And on 31st March 14, the value becomes 14 lakh rupees. So what is the accounting entry? The accounting entry will be impairment loss P&L account debit to building number B, right? So this closing will has become opening. So now in the next year, the value becomes 16 lakh. So now you have to recognize a credit of 2 lakh. So accounting entry will be building account debit 2 lakh to whatever P&L you have debited, you will reverse that P&L minus 1 plus 1, 0. And 1 lakh you have to credit to the revaluation surplus OCI. So accounting entry will be building account debit 2 lakh rupees to impairment loss reversal 1 lakh rupees to revaluation surplus OCI 1 lakh rupees. Right? Now in the third year, this 16 become 13. This 16 become 13, and you can see that there is only 1 lakh rupees of OCI reserve which is lying in the balance sheet. So when this 16 become 13, you have to credit your building by 3 lakh rupees. You have to debit your revaluation surplus OCI by 1 lakh rupees so that there will be zero balance in OCI. And the remaining 2 lakh will go to the P&L as an impairment loss. This will go to the P&L as an impairment loss. I hope revaluation surplus adjustment is clear to all of you. I hope so. I hope it is clear to all of you. Soham is asked, sir, if a class of asset is changed, for example, earlier it was an office building. Now the entity has started using this office building as a factory. Then will that changed asset have to be valued as per that model? And if yes, how will it be accounted? Soham, you are right. If the office building become a factory building, and for example, the office building was accounted for as a cost model, right? Why? Because the entire office building was accounted for on a cost model, right? But when office building becomes a factory building and the entity was using revaluation model for all the factories, in this case, again, when the nature will change, when the use will change, this converted factory building will also be accounted for as a revaluation model, right? And whatever the difference between cost and revaluation model is there. For example, the carrying value in terms of original cost was 10 lakh rupees. But now, after doing a revaluation, it is coming out at 15 lakh rupees. So 5 lakh rupee will be credited to OCI, revaluation surplus, right? And of course, the revaluation model accounting treatment will be used. Clear? I hope it is clear to all of you guys. Clear to all of you? Good. Thanks, Rahul. Thanks for your feedback. I'm glad. Yeah. So friends, now let's discuss what is the use of this revaluation surplus. If there is a revaluation surplus, what is the use of that revaluation surplus, right? So let's discuss the use of the revaluation surplus. If there is a revaluation surplus, what is the use of that revaluation surplus? Just a minute, I'm facing some issue in my PPT. Just give me a minute, guys. Or let's say it's 8:21 now. So let's have a 10 minutes break and we will start after the break, right? Let's start at 8:30, 8:31. me answer the queries raised by some students. Soham has a very good point and he has asked, sir, this means revaluation surplus is to be maintained separately for each asset. Yes, yes, Soham, you are right. If there is a revaluation surplus on one asset and if there is a revaluation loss on another asset, so this revaluation surplus and revaluation loss cannot be adjusted, right? Cannot be adjusted. Okay. So revaluation surplus, which has to be credited in OCI, of course, that will be one amount. But if there are revaluation surplus on 5 assets, in that case, you have to maintain it separately. Okay. You have to maintain it separately. Why? Because I'm also going to tell you the utilization of revaluation surplus. Okay. For example, there are 5 assets and on every 5 asset, there was a revaluation surplus. One asset is going to be sold out, right? So whenever this one asset will be disposed of or whenever this one asset will be sold out, the revaluation surplus pertaining to that asset will be credited to retained earnings, right? So revaluation surplus OCI will be debited and retained earnings will be credited. Okay. So now this restricted reserve will become a free reserve once the underlying asset will be disposed of or will be derecognized. Okay. And you are right, Soham, bang on. You are absolutely right. The revaluation surplus has to be maintained separately for each asset, even within the class of the asset. Then Manini is asking, sir, if any asset changed its purpose of use, then whether it is required to be disclosed. So Manini, when you prepare the fixed asset schedule, right? And in the fixed asset schedule, even I have shown for Reliance Industries Limited, there are class of asset, right? Where you need to show your opening balance of gross block, addition, deletion, closing balance, right? So in my example of office building and factory building, when this one office building will convert to factory building, so in this office building, it will be treated as a transfer or deletion. In the factory building, it is considered as an addition or transfer in. In the office building, it is transfer out. In the factory building, it is transfer in. And of course, if it is a substantial amount, you can show the disclosure in the notes to accounts as well, right? Soham is asking, sir, but how entities maintain it practically? Soham, in the fixed asset register, the entities are maintaining. For example, I have 5 building. This 5 building will be the 5 line item on the fixed asset register, right? So entities are giving the remarks or entities are opening a separate column in the fixed asset register where the entities are giving the balance of revaluation surplus. Okay. Yeah. Let me open my Excel file. I hope my Excel file is visible, friends. Is it visible? Yeah, let's talk about if there is a revaluation surplus. What is the utilization of revaluation surplus? Utilization of revaluation surplus. I hope my PPT, I hope my Excel file is visible. Yeah, Soham, you're right. Yes. So, friends, now in case of utilization of revaluation surplus, I will categorize this in 2 parts, right? First, at the time of disposal of asset. At the time of disposal of asset. If the revaluation surplus exists at the time of disposal of asset, disposal oblique, I would say derecognition of it, right? When the asset is getting derecognized from the book of account, derecognition of asset. At the time of disposal oblique derecognition of asset. Friends, at the time of disposal or derecognition of the asset, the whatever the balance which is lying in the revaluation surplus, that will be transferred to retained earning, right? Balance of revaluation surplus will transfer to retained earnings. Okay. What is the accounting entry, friends? What is the accounting entry? Accounting entry. accounting entry is revaluation surplus, which is of course in the OCI reserve. Revaluation surplus account debit, to revaluation surplus account debit to retained earnings. Okay, revaluation surplus account debit to retained earning, which is credited. I hope it is clear to all of you. Yeah. Second, sir, at the time of derecognition or disposal, we understood. But can we use the revaluation surplus during the life of the asset? Can we use the revaluation surplus during the life of the asset? During the life of the asset. For example, we have revalued the asset and there is a revaluation surplus. The life is 10 year, 20 year. Can I use that revaluation surplus as of now if I'm not going to sell this asset in the next 20 years? Yes. Standard says that during the life of the asset, you can also use the revaluation surplus. But how you will use the revaluation surplus? During the life of the asset. Standard says that during the life of the asset, every year, revaluation surplus can be transferred to retained earnings. But sir, how? Friends, for example, the cost of the asset was 10 lakh rupees and the life was 10 years, right? What is the depreciation per annum? What is the depreciation per annum? So let me discuss with the help of this example. The original cost of the asset was 10 lakh and the life was 10 years. Subsequently, the asset got revalued to 20 lakhs. Hence, what is the depreciation on the basis of original cost? What is the depreciation on the basis of original cost? Of course, 10 lakh divided by 10 years. 10 lakh divided by 10 years will be your depreciation. Your depreciation will be 1 lakh. Your depreciation will be 1 lakh, right? What is the depreciation on the basis of revised cost? What is the depreciation on the basis of revalued amount? Revalued amount. What is the depreciation on the basis of revalued amount? 20 lakhs divided by 10 years. This is coming out at 2 lakh rupees, right? So the original depreciation was 1 lakh and the revised depreciation due to revaluation become 2 lakhs, right? And in this case, when you are doing the revaluation, you are crediting your revaluation surplus by 10 lakh rupees and you are debiting your PPE by 10 lakh rupees. So friends, there is a revaluation surplus OCI which was credited by 10 lakh rupees, and over the next 10 years, every year you will have an extra hit in the P&L by way of depreciation for rupees 1 lakh, right? Why? Because initially the depreciation was 1 lakh. Now this depreciation become 2 lakhs. So standard says that the revaluation surplus can be utilized every year, to the extent of extra depreciation, right? So in this case, earlier, what you were doing, you were passing an entry depreciation account debit to accumulated depreciation, right? You are passing an accounting entry of 1 lakh. Now you need to pass an accounting entry of 2 lakh. So in the P&L, you are getting an extra hit of rupees 1 lakh. So standard says that to the extent of that extra hit, you have debited your P&L. It means your retained earning is lower. So to that extent, what accounting entry you will pass? You will pass revaluation surplus account debit. Again, revaluation surplus OCI account debit to retained earnings. Retained earnings. To the extent of what? To the extent of what? To the extent of extra depreciation. Depreciation. To the extent of extra depreciation. So friends, every year revaluation surplus will be transferred to retained earnings for additional depreciation. What is the additional depreciation? What is the extra depreciation, or what is the additional depreciation? Extra, or let's say additional depreciation. Additional depreciation is equal to depreciation on revalued amount minus depreciation on original cost, right? Depreciation on revalued amount minus depreciation on original cost. So this is how this revaluation surplus is going to be utilized. I hope it is clear to all of you, friends. I hope it is clear to all of you. Yeah, clear? Any doubt, friends? Please tell me if there is any doubt. Good. Friends, now let's discuss illustration number 5 of Institute study material. So let me share the ICI study material with you guys, and please let me know if this study material is visible. I hope this study material is visible, guys. Illustration number 5 of Institute study material. Utilization of revaluation surplus, right? An item of PPE was purchased for rupees 9 lakh on 1st April 2001. What was the cost? The cost was 9 lakh on 1st April 2001. It is estimated to have a useful life of 10 years and is depreciated on a straight line basis. So if straight line basis is there, a depreciation method is SLM, life is 10 years, and 9 lakh rupee is the cost. Okay. So your depreciation would be 9 lakh divided by 10, 90,000 rupees. On 1st April 2003, which means after 2 years, the asset is revalued to 9,60,000. Okay. So we need to calculate the carrying value on 31st March 2003, and we need to compare the carrying value with the revalued amount, which is 9,60,000 rupees. And the useful life remains unchanged as 10 years. So at every point of time, there was no revision in the useful life. I mean to say the total useful life was 10 years only. So you have to depreciate the carrying value over the remaining life, right? You have to ignore the impact of deferred taxes. We are not taking any impact of deferred taxes of now. Otherwise, you are aware that in case of depreciation, in case of revaluation, there is an impact of deferred tax. You are required to show the necessary treatment as per Ind AS 16 to calculate depreciation and revaluation surplus for 2003 and 2004. Right? Clear? Friends, let's solve this study material. Let's solve this problem. Solve this illustration in the Excel file so that you will have a more and better understanding. Yeah. So this is illustration number 5 of study material. Illustration 5 of ICAI study material. Yeah. So what information is given? Information is given. Original cost is given. How much is the original cost? 9 lakh is the original cost. Then your life is also given. Life is 10 years. Sorry, life in years, which is 10 years. Okay. Hence, what is my yearly depreciation? What is my annual depreciation? Annual depreciation What is my annual depreciation? My annual depreciation is 9 lakh divided by 10, 90,000 is my annual depreciation, right? This is my annual depreciation. Okay. What is my WDV? What is my WDV at the end of 2 years? Because it is given in the question that after 2 years on 1st April 2003, the revalued amount is 9,60,000. What is my WDV at the end of 2 years? 9 lakh is my original cost. 9 lakh is my original cost, right? WDV or carrying value is 9 lakh minus depreciation for 2 years. 9 lakh minus 9 lakh minus 90,000 multiplied by 2, right? 7,20,000 is the WDV at the end of 2 years. Now your revalued amount. Revalued amount is given in the question for 9,60,000. For 9,60,000 revalued amount is given in the question, right? Friends, in comparison to 720, the revalued amount is 9,60,000. What is my revaluation surplus? My revaluation surplus is 2,40,000. What accounting entry I need to pass? I need to pass an accounting entry of what? I need to pass an the accounting entry at the end of 2 years. At the end of 2 years, I need to pass this accounting entry and I need to debit my PPE account debit to revaluation surplus OCI to revaluation surplus OCI. This needs to be credited. Revaluation surplus OCI needs to be credited. By how much amount? 960 minus 720. 240 is your revaluation surplus OCI, right? Now, friends, we have to utilize the revaluation surplus during the lifetime of the asset, right? This is not about disposal. There is no information regarding disposal. The question is asking that what will be the treatment. You are required to show the treatment as per Ind AS 16 to calculate depreciation and revaluation surplus, right? Friends, you can utilize it is at our discretion. If you don't want to utilize, you can ignore. Okay, utilizing the revaluation surplus. So we have calculated the depreciation. We have calculated the revaluation surplus also. Now utilizing the revaluation surplus during the life of that, right? Friends, what is the remaining life after 2 years? The remaining life is 8 years. What is the remaining life after 2 years? It is 8 years now. It is 8 years. So how much I can transfer from revaluation surplus to retained earning in the next 8 years? How much I can transfer from revaluation surplus to the retained earning in the next 8 years? Please tell me. Please tell me how much I can transfer from revaluation surplus to retained earnings in the next 8 years. How much I can transfer? I can transfer to the extent of additional depreciation. What is the additional depreciation? What is the additional depreciation? Additional depreciation is equal to depreciation on revalued amount minus depreciation on original amount, right? Depreciation on revalued amount minus depreciation on original amount. Sir, what is the depreciation on revalued amount? If the revalued amount is 9,60,000, then depreciation on revalued amount is equal to how much? 9,60,000 divided by 8, because 8 years is the remaining life. How much is the depreciation on original amount? How much is the depreciation on original amount? If the revaluation not happen, then how much they are going to charge as a depreciation? 90,000, right? Sorry, 90,000. So what is the additional depreciation? Additional depreciation is your 120 minus 9. What accounting entry I need to pass? For every year, I can pass revaluation surplus CI account debit to retained earnings. Because retained earnings was debited by 30,000 due to this revaluation, due to the extra hit in the P&L. So we will credit the retained earnings by this amount. So this is the accounting entry. These are the calculation which is required to be made for the utilization of revaluation surplus during the life of the asset. I hope it is clear to everyone, guys. I hope it is clear to all of you. Let me know if you have any query, any questions, any doubt. I would be happy to answer that. Let me know. And I'm sure you guys have understood this concept. First, I have given you the concept. I have also told you the accounting entry. I have given you the example. Then I have taken an illustration from Institute study material, right? Yeah. I hope it is clear to all of you now, guys. This is the steps by which the problem can be solved, right? Clear? Is it clear, friends? Yeah. So let's move to the PowerPoint presentation. And we have discussed that the revaluation surplus is utilized by way of transfer to the retained earning always when the asset is derecognized, means end of the lifetime of the asset. The entire revaluation surplus will transfer to retained earning, but during the lifetime of the asset, when the asset is being used, revaluation reserve may be transferred, and the amount of revaluation surplus transferred is equal to depreciation based on the revalued amount minus depreciation based on the original cost. But always this revaluation surplus should be routed through the retained earning and not through the profit and loss. You cannot credit your P&L. You have to credit your retained earning, right? I hope the concept of revaluation model, the concept of revaluation surplus, the treatment of revaluation gains and losses, the treatment of utilization of revaluation surplus is clear to all of you guys. I hope it is clear to all of you. Soham is asking, sir, why to transfer after hitting P&L when we can do it in first place? Soham, there are some accounting principle and accounting discipline, right? OCI is a reserve. Okay, OCI is a reserve. And this revaluation surplus is related to the fixed assets. Okay. And even in our old accounting standard, this revaluation surplus never transferred to the P&L. It was always moving from one reserve to another reserve. So this revaluation surplus OCI is in the nature of reserve only. From the reserve, you cannot take it to the P&L. From the reserve, you cannot take it to the P&L. And that is why Ind AS 16 says that, whatever excess you have charged in the P&L in terms of depreciation, not in terms of reserve, in terms of depreciation, whatever you have charged, to that extent, we will transfer one reserve to the another reserve just to compensate that. We will transfer it to retained earnings, right? Why? Because this extra hit is coming out due to the revaluation. So at one time, you are deflating your reserve, which is retained earning, by way of extra hit to the depreciation. In the another time, when you are revaluing, you are crediting your OCI reserve. So that is why, just to compensate this retained earning, the standard says that if you want to transfer this revaluation surplus to retained earning, you can transfer during the life of the asset on a pro rata basis, on a proportional basis to the extent of additional depreciation. If you don't want to do that, even that is allowed. Even that is allowed, right? Yeah, clear? So I would request all the students who are watching this live session, I would request your response. I am able to see the response provided by Manini, Soham, Radhika, Rohan, Rahul, and Srishti only. I'm not able to see the response from other participants. Like Rashmi is there, like Aisha is there, Grish is there. So friends, Are you enjoying the class? Have you understood the concept which I have taught you since last 1 hour and 56 minutes? Yeah, good. Now let's discuss the next important concept, which is depreciation. What is meant by depreciation? What is meant by depreciation? Friends, for example, if you are giving a salary to your employee, or let's say if you are paying a rent, okay, if you are paying a rent, you are debiting your P&L on a real time basis, but if you have purchased a machinery, you will use that machinery, for the next 10 years, right? And when you will use that machinery, you will produce goods and services, you will produce the goods. After selling the goods, you will get the revenue, and revenue has to be recognized in the P&L. And for producing the goods and selling it into the market, you have to incur some cost also. You have to debit that cost to the P&L as well. So friends, whatever cost you are incurring, you are debiting to the P&L, and whatever revenue you are earning, you are crediting to the P&L. And let's say the life of the machinery is 10 years and the cost of the machinery is 1 crore. And during the life of the asset, during the life of this machinery, the machinery is able to produce the goods worth rupees 2 crores. Goods worth rupees 2 crores. For producing the goods, for selling the goods worth rupees 2 crores, there are some efforts, there are some cost which is involved from the company side. The first one is raw material cost, processing cost, labor cost, overheads, right? Direct expenditure, indirect expenditure. So you are recognizing all those expenditure, and when you are comparing with the revenue, you will find your profit or loss. But friends, don't you think that in the 10-year period, in the 10 years time, this entire machinery worth rupees 1 crore will become a nil value, will become a zero value asset? It means the expense or the money which you have incurred in the beginning or at the time of purchase of machinery, 1 crore, whatever you have spent, you have capitalized. So nothing has gone to the P&L. So don't you think that while considering the profitability, while calculating the profitability, you have to consider the cost of the machinery over a period of 10 years also? Like a prepaid concept. Today you have spent 1 crore rupees and you will get the future economic benefit for the next 10 years. Don't you think this 1 crore should be debited to P&L in some manner? Don't you think? Otherwise, it will not give you the true profitability, true picture of the profit or loss. Yeah. So what could be the form? In which we will debit the cost of property, plant and equipment in our P&L account? What is the form and what would be the name of that? Because you have spent today, you have capitalized, you have recognized as a PPE. There is no expense. So what could be the form or what could be the name in the P&L in which the cost of the machinery is gradually taken over to the P&L, so that whenever the machinery will become zero, the company would have already factored the usage of that machinery in the P&L. So the name is depreciation. What is meant by depreciation? Depreciation means consumption of future economic benefit of that asset over the useful life, over the useful life. So friends, depreciation means the depreciable amount of an asset should be allocated. The depreciable amount. What is a depreciable amount? Depreciable amount is equal to your cost minus residual value. For example, today you have purchased a machinery for 1 crore and you are aware that even I will sell this at a scrap, I will be able to realize 5 lakh rupees. So 1 crore minus 5 lakh is equal to 95 lakh. 1 crore minus 5 lakh is equal to 95 lakh. My depreciable amount is 95 lakh. 95 lakh. Okay. Should be allocated. The depreciable amount of an asset should be allocated on a systematic basis. On a systematic basis, right? Systematic basis means on the basis of consumption of future economic benefit. On the basis of consumption of future economic benefit. If you are find that my future economic benefit is consistent, right? So I am getting, or the future economic benefit is accrued evenly during the period, during the life of the asset. Okay. So in that case, straight line method will be the most appropriate method for depreciation. Right? Straight line method will be the most appropriate method of depreciation in that case. If you find that your future economic benefit is decreasing over the period of time, in that case, WDV method, written down value method, is the most appropriate method of depreciation. If you will find that the life of the asset is on the basis of the usage hours, the life of the asset is on the basis of the productivity, right? It is on the basis of the units. For example, when you go to buy a projector, have you seen a projector? There must be a projector in your office, in your CA office, in your CA firm, or you must have seen the projector in your client place, or if you have taken a real life classes, you must have seen the projector as well. Friends, when you go to buy a project, for example, you have went to buy a Toshiba projector. When you ask the life of the projector, the supplier or the vendor who will not say the life in years. He will say the life in lamp hours. He will say that the life of the projector would be 30,000 lamp hours, right? 30,000 lamp hours. For example, in the first year, you have used only 5,000 hours. In the second year, you have used only 10,000 hours. In the third year, you have used only 0. You have not used due to the COVID, you have not used. So friends, if the life is on the basis of units, for example, if you will purchase a machinery and the vendor will say that the machine will able to produce only 10,000 unit of quantity. So if the life is on the basis of units, in that case, the systematic basis or the appropriate method of depreciation will be the unit of production method or unit of digit method, right? So whatever digit, whatever units you have used, you have to depreciate it in that manner, right? So the depreciable amount of an asset should be allocated on a systematic basis over its useful life is known as a depreciation. Depreciation charges should be recognized as an expense unless they are included in the carrying amount of another asset. I am using my crane in the construction of my factory. I'm using my crane in the construction of my factory. For let's say, and the construction of the factory took 1 year. So 1 year depreciation of crane will be capitalized in the cost of the factory, right? Will be capitalized in the cost of the factory. Otherwise, the depreciation on crane would be charged to the P&L. Okay, is it clear? Right, friends. Standard says that if the significant component, if there are significant component of a particular asset, for example, aircraft, right? The engine of the aircraft has a different life. The inspection element of the aircraft has a different life, and the entire aircraft other than engine has a different life. Okay, it is having a different life. Friends, in this case, if the aircraft has a different life, in this case, what we are required to do? Standard says that if there are different or significant components which is having a different useful life, significant components are having a different useful life, are having a different useful life, then those components needs to be depreciated separately. Friends, let me show you the Indigo Airlines annual report. I hope this annual report is visible to all of you. Let me show you the annual report of Indigo Airlines. And let me show you the accounting policy of the annual report. Property, plant and equipment 3A. You can see the accounting policy part. Let me show you the accounting policy. Property, plant and equipment. Okay. Recognition and measurement. The item of property, plant and equipment are measured at cost less accumulated depreciation and accumulated impairment losses, right? If any. The cost of an item of PPE comprises its purchase price, including import duties and non-refundable purchase taxes, right? After deducting trade discount and rebates, and any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable and operating in the manner intended by the management. They have not written the third one, which is estimated cost of dismantling. Why? Because it is not applicable to Indigo. If significant part of an item of PPE have different useful life, then they are accounted for as a separate component of PPE. The company has recognized major inspection cost. Friends, please see, the company has recognized major inspection costs relating to the engine. The company has recognized the major inspection cost relating to engine and just a minute. Engine and airframe overhauls, right? You remember I have told you the major inspection, major overhauls and airframe overhauls and other heavy maintenance as separate component for owned aircraft. Under Ind AS. Right? Is it clear? So major overhauls, major inspection, they have shown as a separate component. Why? Because it has to be changed at a regular interval, right? For example, 3 to 5 years. But the life of the aircraft is 20 years, right? The life of the aircraft is 20 years. I hope it is clear to all of you guys. Yeah. Good. So let me move ahead and let me show you this thing. Owned aircraft and spare engines. Aircraft and engine component including a spare engine 20 years. Major inspection and overhaul cost 2 to 12 years. Right? So you can see that. You can see the real life example of major inspection also. Right? Friends, is it clear? Have you got some confidence after looking at the Indigo Airlines annual report? Whatever you are reading, whatever you are studying in CA final, you can see that thing in your real life. Friends, have you got some confidence or not? Tell me. Have you got the confidence? Good. Very good. Yeah. So if there are significant component could be major inspection, overhauls, major replacement, right? And these significant component will have a different useful life. In that case, this significant component has to be depreciated separately. Like Indigo Airline is depreciating the major inspection and overhauls into the different useful life and the remaining engine and aircraft into the different useful life. Okay. Clear? each major part of an item of PP with cost significant in relation to the total cost of the item should be depreciated separately. If different parts have same useful life and depreciation method, such parts may be grouped for determining depreciation charges. Friends, sir, what is meant by significant? So how we can determine that yes, it is a significant amount, or that part, how we will determine whether the tires for car will be a significant one, right? So sir, of course we need to replace the tire in every 4-5 years, but the value of the car is, let's say, 30 lakh rupees and the value of the tire is 50,000 rupees. So can we say that the tire is a significant component? Because of course it's a different useful life. Can we say that a tire is a significant component? Friends, normally, practically what companies do, the significant is not defined in Ind AS 16. Company will make a policy that any item, any component which is having a value of more than 5% or value of more than 10% of the entire asset, for example, going by the 5% criteria, if the value of the car is 30 lakh rupees, what is the 5%? 1.5 lakh. So any item which is a significant item, significant component means any component which is having a value of more than 5% of the total cost of the asset will be considered as significant. Okay. So whatever component which is having a value of more than 1.5 lakh in this example of a car will be considered as a significant component and has to be depreciated separately if the useful life is different. An asset has a 5 component, okay, 5 component, but the useful life is the same life. The useful life for all the 5 component is 5 years. In that case, there is no need to separate the depreciation on each component. Okay, there is no need. But if there are significant component and that significant component has a different useful life, in that case, the component has to be depreciated separately for calculating or arriving at the total depreciation for this entire asset. I hope it is clear to all of you guys. Very good. Very good. Aniket, I hope you are able to understand the entire concept of Ind AS 16. Good. Now the question arises, sir, when the depreciation will start? When the depreciation will start? And there are many questions raised during the COVID time, right? During the COVID time, the asset was available for use. The asset was available for use, but government has put the restriction that nobody will move out from the house, from their house, right? And that is why the companies were not using the asset, right? But probably the industries which were allowed to operate, they were using those assets. So standard says that there is no concept of put to use. The concept is depreciation of an asset starts when it is available for use. As simple as that. So depreciation of an asset begins when it is available for use. And what is the meaning of available for use? When it is in the location and condition necessary for it to be capable of operating in the manner intended by the management. Right? So of course, during the COVID time, the assets was in the location, in the factory premises, and in the condition which is necessary for them, for it to be capable of operating in the manner intended by the management. Of course, management was using those assets, right? So friends, the asset was available for use and hence depreciation is required to be charged. So many companies have raised this query to ICAI that during the COVID time, for the COVID period, should we stop charging depreciation in the P&L? Then ICAI has issued a guidance note. During the COVID time, ICAI has issued a guidance for treatment of accounting treatment during COVID. And ICAI has clarified that Ind AS 16 says that the depreciation of an asset begins when it is available for use. And the asset was available for use during the COVID time. The asset was in the location and condition necessary for them to be operated in the manner intended by the management, and hence depreciation will continue to be debited in the P&L. Depreciation is charged till that point where residual value is greater than and equal to carrying amount. So depreciation has to be charged till the residual value. For example, the cost is 100. The cost is 100 and the residual value is 20. So of course, the maximum depreciation is 80. So when you charge 80, your carrying value will become 20, which is equal to your residual value. Or if or if your residual value is greater than your carrying value, then you have to stop charging the depreciation, right? Because residual value is something where you are expecting that you will get the money out of it, right? So you have to depreciate only to that extent where you are aware, where you know that I will not be able to get anything. So whatever I have used, I have to debit to the P&L in the form of depreciation. Yeah. Depreciation ceases when an asset is derecognized or held for sale under Ind AS 105. Sir, if the entity decided to sell the non-current asset, to sell the PPE. So when the criteria of Ind AS 105, Ind AS 105 is a standard which talks about non-current asset held for sale and discontinued operation. So if the criteria for non-current asset held for sale will met, which I will discuss with you guys during my Ind AS 105 session, okay? So if the criteria for classification of asset held for sale will met, in that case, the asset will go to Ind AS 105 and this PP will not remain in Ind AS 16. You remember we have discussed the scope part, and in the scope, the PP classified as held for sale will be out of the scope of Ind AS 16. So if the PP will be classified as held for sale, then it has to be treated under Ind AS 105 and depreciation will be ceased when the asset is derecognized or it is held for sale. Depreciation will be stopped. Sir, if there is a less demand or there is a COVID time, so the asset was sitting idle. The asset was sitting idle. Should we stop the depreciation? Answer is no. Depreciation does not stop automatically when the asset is remaining idle. Depreciation is required to be charged at that point of time. Okay. Clear? So depreciation method. So friends, I have discussed that there are 3 depreciation methods, right? SLM, just a minute. Or let me just wait for a minute. News. Yeah. So friends, depreciation method. So depreciation method depends on future methods depend on future economic benefit. Just a minute. Future economic benefit, right? So how you are arriving your future economic benefits? For example, your future economic benefit. For example, your future economic benefit. Your future economic benefit, for example, your future economic benefit is consistent. Consistent means you will accrue the consistent future economic benefit over the life of the asset. It means the consumption of the asset is even, is consistent. So you have to apply straight line method. In that case, depreciation will be equal over the year, equal depreciation, right? If it is your future economic benefit is having a reducing trend, the future economic benefit is having a reducing trend, then WDV, if the future economic benefit is in the reducing trend, it means your consumption of the asset will also be reduced over the period. So it means WDV is the appropriate method of depreciation, right? In the initial year, higher depreciation will be charged, and in the subsequent year, lower depreciation will be there. So higher depreciation in initial years. The third one is a unit of production method, right? So the third one is when the future economic benefit will be arrived only when the asset will be used. So on the basis of usage, in that case, unit of production method or unit of digit method is the most appropriate example, most appropriate method, unit of production method, right? So in this case, the depreciation will be charged on the basis of usage, right? On the basis of usage. So friends, your consumption of the asset will be determined by the expectation of future economic benefit, which will flow to the entity from using that asset. If it is consistent throughout the life of the asset, then SLM method is the most appropriate method. If it is the decreasing trend, in the initial year, you will be able to produce more output. So it will go down subsequently, right? In that case, WDV method is more appropriate. And if it is only on the basis of usage, like I have told you, when you go to buy a LED bulb, right? I'm just taking an example. So the life is not in years, the life is into the hours, right? Laptop projector, right? So when you go to buy a projector, the life is into the hours, right? So in that case, how many hours you have used, you have to compute depreciation according to that. So friend, during the COVID time, the companies which were using the SLM and WDV method, so they had to charge the depreciation. But the companies which are using the unit of production method, so they have not charged depreciation during the COVID time when there was no production. Why? Because the asset has not been used, right? So friends, depreciation method adopted should reflect the pattern in which the asset future economic benefit, is expected to be consumed by the entity, right? So SLM means constant charge, WDV diminishing charge, and sum of unit means charge based on the expected output. Clear? So change in method is accounted for a change in estimate, not a change in policy. So friends, you have read Ind AS 8 also, change in policy, change in estimate. If there is a change in policy, it has to be applied retrospectively. But if there is a change in estimate, it has to be applied prospectively. Right? Friends, the change in depreciation method is considered as a change in accounting estimate. Why? The change in depreciation method will show the change in the consumption pattern, will show the change in the future economic benefit. And this is an estimate, not a policy, right? So change in depreciation method is known as a change in estimate. Okay. Is it clear, friends? Good. Now discuss this illustration number 7, change in depreciation method. An entity acquired an asset 3 years ago at a cost of rupees 50 lakh, 5 million. The depreciation method adopted for the asset was 10% WDV method. What does it mean? It means initially when the asset was acquired, the cost was 50 lakh. Then the method of depreciation was WDV. So in the first year, the depreciation in the first year was going by the 10% criteria. The depreciation was 50 minus 5. So the carrying value was 45. Depreciation was 5. In the second year, 10% of 45, it will come out as a 4.5. So the remaining balance is 40.5. In the third year, it is coming out at 4.05 and the carrying value is 40.5 minus 4.05. Okay. At the end of year 3, the entity estimated the entity estimated that the remaining useful life of the asset is 8 years. So the remaining useful life is 8 years and determined to adopt straight line method from that date so as to reflect the revised estimated pattern of recovery of economic benefits. You are required to show the necessary treatment in accordance of Ind AS 60. Friends, so at the end of the third year, the entity decided to adopt SLM from WDV. So what is the treatment? Of course, it is an estimate. So prospectively, whatever is the carrying value, prospectively depreciation is required to be charged on the SLM basis. Friends, in the first year, what was the depreciation? 10% of 50 lakh is 5 lakh. In the next year, it will be 4.5 lakh. In the third year, it will be 4 lakh 5,000. So whatever is the closing balance? What is the closing balance? In the first year, 45 lakh is the WDV. On this WDV, depreciation has been charged in the second year. So this will become the WDV at the beginning of third year. So this will become the WDV at the end of the third year, right? So 36,45,000 is the WDV at the end of the third year, right? Year three onwards, method of depreciation has been changed from WDV to SLM. So what is your fourth year of depreciation? So your fourth year of depreciation will be 3645 divided by 8. 3645 divided by 8, right? So from year number 4 to year number 11, every year the depreciation will be 4,55,625. How it have been arrived? It have been arrived at 36,45,000 divided by 8. It will give you 4,55,625, right? So change in depreciation method has to be applied prospectively. Whenever you are changing a depreciation method, whatever carrying value is there at the time of change, you have to charge depreciation on the basis of that carrying value. That will become your value for charging the depreciation prospectively, right? Here, any doubt, any challenge? Good. Sir, there is change in depreciation method or change in useful life or change in residual value. Of course, this change is required to be treated as a change in estimate. But whether, since it is an estimate, so do we need to reassess the useful life or residual value estimate? Yes, standard says that useful life and residual value is required to be reassessed at every year end. At least once in a year, at least at the end of every reporting date, you have to reassess your useful life and residual value. And if there is any change in useful life or residual value, this has to be treated as a change in estimate and not as a change in policy. And this change has to be applied prospectively. For example, the cost of the asset was 100 rupees, right? Cost is 100 rupees and the residual value is 20 rupees at the time of inception. Life is 10 years. SLM method is adopted. What is the depreciation for first year? Depreciation for first year. What is the depreciation for first year? The depreciation for first year is 100 minus 20, which is depreciable amount, divided by 10. This will come out at 8 rupees, right? So 8 year is the yearly, 8 rupees is the yearly depreciation. After second year, the company, when estimated the residual value, it found that it is 30 rupees. The residual value is 30 rupees. So now going forward, how much depreciation you are required to be charged? So going forward, you are required to charge how much of depreciation? So friends, at the end of second year, what is the carrying value? At the end of the second year, the carrying value was 100 minus 8 rupee depreciation for the first year, 8 rupee depreciation for the second year. So the carrying value was 84 rupees, right? Carrying value was 84 rupees. And what is your estimated residual value? It is 30 rupees. Estimated residual value is 30 rupees, right? 84 minus 30. So now this has to be divided by 8 for calculating the future depreciation. So 84 minus 30 divided by 8 means 54 divided by 8. So this will comes out at 6.8 something, right? 6.8. Clear? I hope it is clear. I hope it is clear. So it has to be applied prospectively. If there is a change in residual value, again it is considered as a change in estimate. If this residual value would not have been changed, then 84 minus 20, this comes out 64. 64 divided by 8 rupees, which is the yearly depreciation, right? So friends, every year you have to reassess your residual value and you have to reassess your useful life. And if there is any change, so you have to consider your carrying value and the changes, and whatever the impact will be there, it has to be taken prospectively. Let's discuss the illustration number 12, right? XYZ Limited purchased an asset on 1st January 2000 for rupees 1 lakh. And the asset had an estimated useful life of 10 years and a residual value of 0, nil. So 1st January 2000, cost is 1 lakh, life is 10 years. What is the yearly depreciation? 1 lakh divided by 10. What is the yearly depreciation? What is the yearly depreciation? Yearly depreciation is 10,000. The company had charged depreciation using the straight line method at rupees 10,000 per annum. The company had charged depreciation using the straight line method at 10,000 per annum, right? On 1st January 2004, it means after 4 years, 2000, 2001, 2003, 2004. No, after 3 years, right? The management of XYG Limited reviews the estimated life and decides that the asset will probably be useful for further 4 years. And therefore, the total life is revised to 8 years, right? So 1st January 2000, so up to 31st December 2000, 1 year, 31st December 2001, 2 year, 31st December 2002, 3 years, 31st December 2003, 4 years. Sorry, 4 years was there. And at the end of the 4 years, the company has reviewed the useful life and decided that the remaining life is not 6 years. The remaining life is 4 years only. And the total life is 8 years. Okay. So how should the asset be accounted for remaining year? First of all, if the cost is 1 lakh, SLM method is used, the life is 10 years. So what is the accumulated depreciation? What is the accumulated depreciation at the end of 4 years? Guys, first of all, calculate the carrying value at the end of 4 years. Carrying value at the end of 4 years. Cost, which is 1 lakh, minus depreciation for 4 years. What is the depreciation for 4 years? Accumulated depreciation. So 1 lakh minus 40,000, which is your 60,000. 60,000 is your WDV. 60,000 is your WDV, right? If this useful life would not be changed, then of course, this 60,000 would have been depreciated over a period of next 6 years because the life was 10 years. So every year 10,000 would be there. But since the life have been changed and the remaining life is not 6 years, the remaining life is 4 years only. So in this case, this 60,000 has to be depreciated over the remaining useful life. And the remaining useful life is 4 years. So the prospective, the depreciation is 60,000 divided by 4, which is 15,000 every year, right? So friends, change in useful life of an asset is change in accounting estimate, which has to be applied prospectively. That is, the depreciation charge will need to be recalculated. On 1st January 2004, when the asset net book value is 60,000, the company should amend the annual provision for depreciation to charge the unamortized cost, which is 60,000, over the revised remaining life of the 4 years. Consequently, it should charge depreciation for the next 4 years at 15,000 rupees per annum. At 15,000 per annum, right? Clear, friends? At 15,000 per annum. Clear? Good. Now let's come to the last concept of the standard, retirement and disposal. So we have discussed the recognition, we have discussed the initial measurement at cost, we have discussed the subsequent measurement cost model, revaluation model, we have talked about the utilization of revaluation surplus, we have talked about the depreciation, right? We have talked about the depreciation also. Depreciation methods, change in estimate. Now we have reached to the end of the life cycle of the PPE. When PPE is going to be derecognized, when PPE is going to be disposed of. So the carrying amount of an item of PPE in the balance sheet shall be derecognized, shall be derecognized. You remember in the starting, we have talked about the recognition, recognized, right? And we talked about two things. One, future economic benefit is probable and cost can be measured reliably, right? At the time of recognition, these two conditions will be satisfied. So if the company has expected that no future benefit is expected from the use of the asset, no future benefit is expected from the use or disposal, in that case, the asset is required to be derecognized. So the carrying amount of the PPE in the balance sheet shall be derecognized on disposal when the company is actually selling the property, or when no future economic benefit is expected from its use or disposal, when the company is not expecting any future economic benefit, right? So the company was using a machinery, and let's take an example of a car. So the company was using a diesel car, right? And the company was using since last 6 years, and it was running very smooth and very fine. It was running fine. So after 6 years, the government come up with an announcement to stop the use of diesel cars due to the pollution, right? So in this case, whenever the government has come up with such an announcement, the future economic benefit is not expected from the car. And even the future economic benefit is not expected from the disposal of the car, because no one will buy the car except scrap. No one will buy the car, right? So friends, the PP is required to be derecognized when it is actually sold out or when no future economic benefit is expected. Whatever gain or loss will be there, that gain or loss will be recognized in P&L as a other income, not as a revenue from operations, right? So the gain or loss from PP is not a revenue from operation, it is other income. So these gains and losses will be recognized in P&L when the asset is going to be derecognized, right? Any doubt so far, guys? Any doubt? Just to check whether you have understood this standard, I have 10 objective type question on the concepts, right? Shall I start that? Before this, let me summarize the entire standard in the next 10 minutes. Students, we have started this standard first of all with the definition of PPE. What is the definition of PPE? Property, plant and equipment is a tangible item which is held for production or supply of goods and services, held for rental purposes, administrative purposes, and is expected to be used for more than one period, right? And all the item of PPE is covered under Ind AS 16 except biological asset used in agricultural activity, except PP classified as held for sale, and exploration and evaluation assets, which is considered under Ind AS 06, right? And the PP is going to be recognized when two conditions will be satisfied. Future economic benefit is probable and cost can be measured reliably. If the company is also acquiring some spare parts, tools, right? Like in case of Indigo Airlines, the company is also buying a spare engine, right? So that spare engine is also required to be capitalized as a property, plant and equipment if it is meeting the definition and recognition criteria. Otherwise, it will be taken as an inventory. Okay. Second, in case of a subsequent cost, if the entity is incurring a subsequent cost in the form of major replacement, major overhauls, major inspection, right? So those subsequent costs are also going to be capitalized in the PPE if recognition criteria is meeting. Future economic benefit is probable and cost can be measured reliably, which is generally the case. Okay. But in this case, the original component has to be derecognized, decapitalized, and the new component is required to be capitalized. Okay. So how to arrive at a value of a original component? If the value is not given, you have to discount the cost of the current component to the date of original purchase. You have to discount, and by that you can arrive at a cost of the original component. And the WDV, then you have to depreciate, and the WDV of the original component needs to be derecognized or decapitalized, right? We have discussed two examples, truck and engine and machine and turbine from the ICI study material illustration. Okay. Then we have discussed that once you have decided, yes, it is a PPE, then at what value PP is going to be measured? PP is going to be measured at cost. Cost includes purchase price plus import duties plus non-refundable taxes minus trade discount and rebates, minus trade discounts as well as rebates. Okay. So this is the meaning of cost, but this is the one lag. Plus directly attributable cost should be there, plus directly attributable cost, right? What is meant by directly attributable cost? Directly attributable cost means the cost which is directly related to the acquisition of the asset. Had the asset not been acquired, the cost would not have been incurred, right? Plus estimated cost of dismantling, restoration of site. This is also required to be capitalized as a cost of the asset, right? So we have discussed that. Then we have discussed if the entity is acquiring a PP on the deferred payment terms, then the PP has to be capitalized at a cash price equivalent, and the extra payment made by the entity for buying a PP will be considered as a finance cost, and that finance cost will be debited to the P&L. But if the underlying asset is a qualifying asset, then that finance cost or interest cost should be capitalized as a borrowing cost. Okay. Then we discussed the example of exchange of asset. In case of exchange of asset, the value of the PP is acquired is equal to the fair value of the asset given up, right? But if the transaction is not having any commercial substance or the fair value cannot be identified, then the best amount which is available is WDV of the asset given up, because this is already recorded in your books of accounts, right? Then we have discussed, once you have recognized, then what happens at the reporting date? At the reporting date, you have to depreciate, you have to impair, you have to revalue, right? So at the reporting date, you have to opt for two models, one of the two models as accounting policy choice, cost model or revaluation model, right? If you are opting for cost model, your cost will not change, your gross block will not change, right? Your gross block will not change. And every year you have to arrive at the carrying value by applying the formula, which is cost minus accumulated depreciation minus accumulated impairment losses. And the prospective depreciation is going to be charged on the basis of carrying value, okay? But if you are opting for the revaluation model, you have to revalue the PPE at a sufficient intervals, okay? At a regular intervals, you have to fair value. And in case of fair value, the formula for calculating the carrying value is equal to revalued amount minus subsequent means subsequent to the revaluation, subsequent to the fair valuation, minus subsequent ECDEP minus subsequent impairment losses, right? In case of revaluation, it has to be carried at the regular interval every reporting date if the price change is more volatile. If it is less volatile, you can go with the interval of 3 to 5 years. Single model, I mean to say consistently, either cost or revaluation model is applied to all the individual asset within the same class. There is no cherry picking choice. And this we have seen with the help of two examples. One is for office building and the second one is office and factory building, right? Friends, and if when you are doing a revaluation, first time if there is a revaluation gain, it has to go to OCI reserve. If there is a revaluation loss, it is an impairment loss and conservatively it has to be booked to the P&L. But friends, once you have recognized a revaluation surplus or you have recognized a loss and subsequently the position is different. For example, initially profit, initially surplus, now loss, then this loss has to be adjusted with the surplus which we have booked earlier. Whatever is excess, for example, loss is excess, so excess will go to the P&L. Vice versa, if you have booked the loss, now there is a surplus. To the extent of loss which you have booked, the surplus to that extent has to be charged from the P&L only, has to be credited to the P&L only. But if the surplus is extra, that extra will go to the OCI. Then we have discussed the utilization of revaluation surplus, and we have discussed the revaluation surplus will always go to the retained earnings. If at the time of derecognition or disposal, the revaluation surplus will be transferred from OCI to the retained earning. But if the company wants to use this revaluation surplus during the life cycle of the asset, so the revaluation surplus will be credited to the retained earning only to the extent of extra depreciation on account of revaluation, right? Then we have discussed the concept of depreciation. So what is a depreciation? Depreciation is the allocation of the depreciable amount on a systematic basis over the useful life of the asset. Cost minus residual value divided by life is equal to depreciation, right? So depreciation starts when the asset is available for use. Depreciation stops when the asset is derecognized or classified as held for sale. Depreciation does not stop even the asset is lying idle because it is available for use. And the classic example is COVID, right? So friends, depreciation method shows the behavior pattern of consumption of future economic benefit, consumption of asset, and depreciation method could be straight line method, could be WDV, could be unit of digit method. And these method are estimate. The change in method is known as an estimate. Friends, for PPE, you are required to review your useful life, your residual value at every reporting date, right? And whenever there is a change, that change has to be applied prospectively because it is a change in estimate. And this prospective change has to be applied prospectively. You have to compute the carrying value and you have to recalculate the depreciation on the basis of that carrying value at the date of the change, right? Friends, PP is going to be derecognized. PP is going to be derecognized if it has to be disposed of, it has to be actually sold out, or when the future economic benefit is not expected. If there is any gain or loss on the PP, it has to be charged to the P&L or it has to be credited to the P&L, right? I have summarized this entire Ind AS 16 and I hope you guys have understood, you guys have enjoyed the session. Now let's quickly discuss this multiple choice questions. A change in depreciation method is a change in policy, change in estimate, or change in method. What is the right answer, guys? What is the right answer? Of course, we have just discussed the change in depreciation method is a change in estimate. It is a change in estimate. Okay. It is a change in estimate. Para 61 says that, sir, do we need to write a para? No. You are not required to write any para. Change in depreciation method shall be accounted for as a change in estimate in accordance with Ind AS 8. Is the answer for question number 2. When an asset is sold or disposed of, where is the gain or loss recognized? Asset disposal account, profit and loss, revaluation reserve, depreciation. What is the right answer? Aniket, what is the answer? Thank you, Aniket. Thank you for this wonderful feedback. You are right, Rahul. The right answer is profit or loss is the right answer, right? Profit or loss. The gain or loss arising from the derecognition of an item of PPE shall be included in profit or loss. Under Ind AS 16, how often should the useful life of an asset be reviewed? How often the useful life of an asset be reviewed? At least at each financial year end, every 6 months, at management discretion, or never? What is the right answer? You're right, Radhika. At least at each financial year end, right? Answer is A. The depreciation method applied to an asset shall be reviewed at least at each financial year end. Question number 4. How should an item of PPE be initially recognized in the financial statement? At market value, at cost, at NRV, at fair value? What is the right answer? PPE has to be initially measured at cost, right? So cost is the right answer. Question number 5. If one large asset has a number of individual components with different useful life, how should this be depreciated? There is an asset and that asset has a different large component, right? That asset has a different component and different component has a different useful life. Then how should this be depreciated? Of course, separately. Treat as one asset, break down in different components, expense it all, treat as one asset but disclose in the notes to the financial statement. Friends, सिर्फ disclosure से बात नहीं बनेगी. You have to break down into different component and then you have to depreciate it separately, right? Each part of an item of PPE with a cost which is significant in relation to the total cost of the item shall be depreciated separately. Question number 6. Under Ind AS 16, which two subsequent accounting treatments are allowed subsequently to initial recognition? Cost model, present value, cost and revaluation model, fair value and revaluation model, fair value and cost model. What is the right answer? Yes, cost model and revaluation model is the right answer. B is the right answer. An entity shall choose either the cost model or the revaluation model as its accounting policy and shall apply that policy to an entire class of PPE. Question number 7. When it is blank dash, that future economic benefit associated with an asset will flow to the entity and the cost can be dash measured, it should be recognized as an asset. Possible, reasonably. Possible, reliably. Probable, reliably. Probable, reasonably. What is the right answer? When it is probable that future economic benefit associated with an asset will flow to the entity and the cost can be reliably measured. And the cost can be reliably measured. C is the right answer. Right? Question number 8. Which of the following is not an asset which falls under the scope of Ind AS 16? Tangible asset. Asset held for the production or supply of goods or services. Asset held for sale in the normal course of business. Asset expected to be used for more than one period. Friends, what is not covered in Ind AS 16? Maruti Cars for Maruti Suzuki India Limited. So Maruti Cars is of course an asset for me, asset for you. But for Maruti Suzuki India Limited, whether Maruti car is a PP or inventory, Maruti car is an inventory for Maruti, right? So asset held for sale in the normal course of business is known as a inventory, right? Question number 9. When the revaluation model is used for PPE, the gain or loss should be included in income for the period. Gain from revaluation on the income statement, revaluation surplus account in OCI, an extraordinary gain or loss on the income statement. What is the right answer? Guys, what is the right answer? When the revaluation model is used, there is a revaluation gain or loss. The gain or loss should be included in income for the period. Gain from revaluation on the income statement, a revaluation account in OCI, extraordinary gain or loss on the income statement. What is the appropriate answer? I would say income for the period. Answer is no. The gain or loss should not be included in the income for the period, not be included in the P&L. It should not be in the income statement. So what is the appropriate answer? If there is a revaluation surplus, that revaluation surplus will go to OCI, right? A revaluation surplus account in OCI. Question number 10. Question number 10. Which of these is an allowable cost of an asset under Ind AS section? Professional fees, general overheads, initial operating losses, administration expenses. Guys, out of these 4 expenses, what is an allowable cost? What is an allowable cost? A is only an allowable cost of professional fees. Otherwise, general overheads are not required to be capitalized. Initial operating losses are not required to be capitalized. Abnormal cost. Administration expenses is not required to be capitalized, right? Professional fees is allowed as a cost of an asset. Okay. So thank you so much, guys. If you would have any problem, any doubt relating to this standard, you can contact me at caalokgarg@gmail.com, or you can connect with the Board of Studies. And if you have any query, they will transfer your query to me. Either they will reply at themselves, or they will transfer your query to me and I will revert on that, right? My email ID is caalokgarg@gmail.com. I would request each one of you to please go through with the ICAI study material. Please solve all the questions from ICAI study material. For each and every concept, I have given you an example. I have shown you the accounting entries, and even I have solved around 5 to 6 questions from ICAI study material on all the different concepts, right? Thank you so much, guys. Stay safe, stay happy. Bye-bye. Take care.